ETF investing never stops evolving and now goes far beyond passively tracking index returns. Find out how our active fixed income ETFs, backed by deep research from Manulife Investment Management, can help you be better prepared for whatever lies ahead. Learn more at jhinvestments.com/ETF. This is Exchange Traded Fridays, brought to you by ETF.com. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com. On tap for today, we've got three interesting topics. We're going to be talking about the sudden surge by China ETFs, the big market moves in the week after the Fed's decision to cut interest rates, and the latest news in ETF launches. With me today to discuss all these cool things, my colleagues, Senior Analyst Sumit Roy, Research Lead Kent Tooney, and reporter DJ Shaw. Hey guys, how y'all doing?
Doing well, Jeff. Doing well. Really in awe of these crazy China moves that we're going to talk about.
Yeah. We're going to start with that. It's hard to say how long this run's going to last, but the Chinese government introduced some stimulus, some pretty big stimulus moves earlier this week, and it really pumped up the China ETFs. We saw the iShares MSCI China ETF. That's kind of a big one, $4.3 billion. The ticker is MCHI. And that thing, it started spiking right on the move earlier this week. And it's up over the past 5 trading days, 16.7%. There's a number of China ETFs that are all up in similar fashion, but there's some levered ones if you really want to get crazy. I think anybody that knows me knows how I feel about levered products. They're trading vehicles, folks. Please do not sit in those things and try and save for retirement. But Sumit, what are your thoughts on this China rally we're seeing right now in China ETFs?
It's incredible, Jeff. Like you said, the moves have been eye-popping. You mentioned MCHI. It surged 9% on Tuesday and then another 9% on Thursday. And if you go back to earlier this month, it's up 25% from where it was back then. Another popular one, K-Web, which also has somewhere between $4 and $5 billion in assets. This one focuses on Chinese internet companies. It surged 10% on Tuesday and then 10% on Thursday, and it's up something like 32% from the beginning of the month. I think, clearly given these moves, investors think that all of these Chinese government actions and stimulus is going to positively impact China's economy and by extension, Chinese corporations. I saw David Tepper, who's this billionaire hedge fund manager. He was on CNBC earlier this week, and he was pounding the table on Chinese stocks, saying he's massively overweight China due to the combination of, the stimulus measures as well as the low valuations of Chinese stocks. Now, look, we have to put these moves in context. Chinese stocks have been in the gutter for years now. These stocks haven't gone anywhere for something like 15 or 16 years. And a lot of that has to do with China's economy, which is facing challenges in the form of a housing bust, issues with debt, demographics, et cetera, which, obviously in turn, that's going to weigh on Chinese corporate earnings. And in fact, I took a look at earnings for companies in the MSCI China index, and they've been flat for over a decade. So the question is, are they going to turn around now that the Chinese government is being aggressive and trying to prop up the economy and markets? Maybe. I mean, we've certainly seen that when we get stimulus and easy monetary policies in the US, stocks tend to respond well, but I don't know if that relationship is as strong in China. So if you could kind of hear the tone I'm using, I'm kind of skeptical, right? I'm skeptical that the outlook for China's economy and earnings is going to shift dramatically from these actions. And I'm skeptical that investors are going to start paying high multiples for Chinese stocks because it's not just about the economy and earnings. You have concerns about geopolitics. You have concerns about the system of government over there as well. And these won't go away anytime soon. That said, of course, we could get a short-term rally. We already are seeing that, and maybe that can go on for a while. But what do you all think? Am I being too bearish on China ETFs?
I don't think so. Just because of a rate cut doesn't indicate that the stimulus is going to turn the economy around. In fact, it could be the opposite. I mean, it could be more of a concern. The market tends to move the most on surprises. So we had this big move because investors weren't exactly expecting China to cut rates. But from my view, I would take a step back and see what the big picture, if you will, of the Chinese economy is, why their central bank made such a move, and I would be a little bit cautious on that instead.
Yeah, I want to put a little more perspective on this story. Keep in mind that in late May, the Chinese government did a similar but not quite as extreme stimulus unveiling, and we saw the same kind of spike. If you're looking at any charts at all of the ETFs we've already talked about, pull those up, and you'll see the spike hit a little bit higher than where it is right now for most of these ETFs, and then it went way back down to where it was. These things were in February. So this is it looks really short term. It's hard to say for sure, but this is the second wave of big stimulus. So what they're trying to do is they're trying to get ahead of a deflationary cycle that they see ahead of them. But I don't know if they're doing it. One more thing before we leave this topic, because I mentioned some of the levered products out there for China. If you're into it, if you like wild rides, roller coasters and such, there's a Direction Daily CSI China Internet Bull 2 times. Its ticker is CWEB. That is up 41% over the last 5 trading days. So that's what you get when you play with that kind of fire. But year to date, it's up. Well, year to date, it's up almost 23%. But it has the same trend line as all these other China ETFs. Kind of bouncing along, big spike in May, and then it just found its way back down to a bottom in earlier this month. So
Another area, Jeff, that's being impacted are the broader emerging market ETFs, things like IEMG, VWO. These are big funds, I think, with tens of
mhm.
billions of dollars. They've been rallying too because China just makes up such a big portion of those ETFs. I think it's something like 25%, plus Taiwan, of course, which is another 20%. So 40, 50% of these ETFs are exposed to China, and they've been breaking out, hitting their highest levels in a couple years. I wrote a story earlier this week, actually, about how people haven't been buying those ETFs because they're worried about China. Instead, they've been buying this other iShares product, ticker symbol EMXC. It's the
Mhm.
China ETF it's the emerging markets ETF that excludes Chinese stocks. And people have been piling into that this year, $6 billion of inflows. Clearly, though, they're kind of missing this move up in China stocks. So I don't know, if you exclude China because of geopolitics, miss moves like these, but maybe, over the long term, the people piling into EMXC are making the right bet. Who knows?
Okay, let's talk about the U.S. market and the U.S. Federal Reserve. They cut rates a week or so ago, and first rate cut in over 4 years, 50 basis points. Um, Samit, what kind of ripple effects did we see here?
I think the most interesting thing, I know Ken's going to talk more about it, is the S&P 500 immediately shot up to record highs after that Fed rate cut.
Mhm.
It almost seems too expected, right? Like the Fed cuts rates and stocks hit record highs. Who could have seen that coming? It's too obvious, but that's exactly what's happened. I think a little more counterintuitive was the fact that yields on bonds have moved up every day, not every day, but they moved up almost every day since the Fed has cut interest rates, which, who would have thought that, right? The Fed cuts the Fed funds rate, but the yield on the 10-year Treasury has gone up since that cut. And I think that's just because a lot of bond investors anticipated this. They already priced in a lot of Fed rate cuts when the 10-year Treasury yield hit 3.6% earlier this month. So the Fed funds rate, we have to remember, is still around 4.75 to 5%, while the 10-year is in the 3.6, 3.7 range. So it's already incorporating a lot of Fed rate cuts. Likewise, the 30-year Treasury, it's around 4%, incorporating a lot of cuts. That's why we've seen TLT sell off since the Fed made its cuts. I don't know. What do you think, Ken? Do you think the bond market is already pricing in a lot of cuts, or do you think it's just taking a pause and we can see bond yields drop more from here and TLT go up in price?
Right. Yeah. Good points. Yes. On pricing in the Fed and lower interest rates, I know that a lot of traders do that. They're watching all the inflation reports, PCE and CPI and labor reports and all those things over the last entire year, really intensely, and so they want to be ahead of the Fed rate cut. So, a lot of investors, if they know a little bit about bonds, they might say, well, yeah, I heard that bond prices and interest rates have an inverse relationship. So when the Fed lowers interest rates, I'm going to make a bunch of money off my bond funds. That's not the case because the market's going to price it in advance. Now, since last week, we've had a couple of jobs report and some economic data that is not indicating that inflation is really dropping quickly. And in fact, there are some concerns that, the stimulus could cause a reflation. And that's something that I saw Jeff interviewed some advisors and they were talking about what their concerns were or advice following that. And one advisor I agreed with about that concern of reflation, meaning that you have interest rates falling, and that's going to be good for businesses in general. It lowers their borrowing costs, so their bottom line is going to increase. Also, it's stimulating within the housing market, and so people have more money. We have people refinancing their mortgages, and that can be stimulating, which may introduce some inflation back to the economy. So it's very complex. We talked about that last week, I believe, or the week before. But I think that's part of why you're seeing investors maybe take some money off the table and see what inflation does next. And the coming reports that we have on inflation will help give us a clue on that.
And I'm taking a look at the ETFs that have been the most popular since the Fed cut rates. And by popularity, I mean these are the ETFs that have seen the largest inflows. And you got, obvious ones like SPY. It's seen $22 billion of inflows over the past week. VOO, another S&P 500 fund, the triple Qs. Those aren't really, surprising. But what does kind of surprise me is a T-bill, TBIL, the 3-month bill ETF, has seen $4.2 billion of inflows over the past week. And then another T-bill ETF, XBIL, which is a 6-month Treasury bill ETF, has seen $600 million of inflow. So even though you got the Fed funds rate going down, you have very short-term Treasury yields going down, people are still interested in buying them, maybe to take advantage of, these yields while they can, because obviously they're expected to fall even more over the next year. Another popular ETF over the past week is the one we talked about in the previous segment, EMXC, $500 million of inflows over the past week, which is the 9th largest of any ETF.
Yeah, I think it's interesting to see these flows in reaction or in I guess in the wake of the Fed rate cuts, because we've been talking for a long time about all the money sitting in cash or cash equivalent, because you can get you were getting upwards of 5% in money markets or some of these high yield cash equivalents or bank accounts or even shorter term CDs. And the sense is always, okay, when the Fed starts cutting rates, it's risk on, so money moves to equities. But rates are still kind of above historical norms, so there's still appeal in shorter term bonds, and there's still a lot of, I mean, if you've got a lot of money on the sidelines, it's going to go to stocks and bonds, as I think most people believe. So I don't know. It's kind of hard to say. If it seems like the classic thinking is that this will drive this rate cut cycle will drive the equity markets for maybe a year or so, but it's going to have a longer term impact on the bond markets, I think.
Right. Yeah, I would agree with that. Good point. I was going to add to that where, like Simit mentioned, is that the yields are higher on those short and ultra short term treasuries and the ETFs that track them. And so it's kind of a sweet spot, if you will, kind of a have your cake and eat it too area, because you can get high yields, and if that risk of inflation coming back, the price risk isn't there with those short-term ETFs, the treasuries. But at the same time, if interest rates keep coming down, the yields on those ETFs will come down farther than the long term, which is kind of more of a normalization of the yield curve. So you can get price appreciation on those short-term bond ETFs as well. So you're going to win either way. So I'm not making a recommendation everyone go buy short and ultra short term ETFs, but bond ETFs. But it really is kind of a smart, kind of a safer bet, if you will, than those longer term ones, like TLT.
Yeah, great points, Ken. The only thing I'll mention is that I guess the biggest risk with those ultra short term bond ETFs is the reinvestment risk. So some people are talking about rates going all the way back down to 2% or something like that. If that happens, then obviously, at some point, the yields on those ultra short term are going to go way down, and you might regret not locking in higher rates with longer term treasuries.
Exactly. Good point. Diversification.
Right. All right. So I think we covered the Fed pretty well. Our third and final segment is on launches. I know, DJ, there's been quite a few really interesting launches that you've been covering for ETF.com. You want to talk about this?
Yeah, I'll start with BlackRock and IBIT. The SEC just gave the thumbs up for options trading for this fund, which can be seen as a big step for Bitcoin ETFs, kind of bringing in more investors who want to use option strategies. But this isn't done just yet. There still needs to be more approvals before these options can actually start trading. But I think it'll be interesting to see how this plays out and if it leads to similar approvals for other Bitcoin ETFs. BlackRock is also converting their 1.7 billion high yield municipal fund into an ETF and giving their fund HYMU a bit of a makeover. The new HYMU will focus on short duration high yield munis, which could be attractive in this interest rate environment. But it's also part of a bigger trend of mutual funds turning into ETFs that's been happening lately. State Street is jumping into the target maturity bond ETF space. They launched 14 new funds under their My Income lineup, covering both corporate and muni bonds. These funds all have maturity dates from 2026 to 2034, which gives investors a lot more flexibility. And it's in an area that's been dominated by Invesco and iShares, so it'll be interesting to see how State Street competes. And
Yeah. This is a
sorry.
space, I think you wrote an article, right? DJ had like $50 billion among the iShares ETFs.
Yeah, between both iShares and Invesco.
Yeah. So it'll be interesting to see whether this space can grow. I know, Jeff, you and I did a podcast a while back where we were talking to an issuer, and they were talking about how this is a multi-trillion-dollar space when you consider mutual funds. Obviously, they've caught on a little bit in the ETF space, but we'll see if it can get to those type of numbers when it comes to ETFs.
There's one more that I wanted to mention. Texas Capital Bank, they're trying something new with their fund MMKT. They're calling it the first ETF to follow Rule 2A-7, which governs money market funds. So unlike traditional money market funds, MMKT won't maintain a stable $1 net asset value. Instead, it'll calculate that based on the market value of its investments. So I think this could be a bit of a game changer for the money market industry, offering a new way to manage cash with the tradability of an ETF.
Yeah, I thought that was a pretty interesting concept, what they're doing with that money market fund. I mean, money market investors are usually savers. They're usually the money is there for conservative reasons because they don't want it flying all over the place or they don't want the NAV fluctuating. I'm wondering if this is something that has maybe could have been done a long time ago, but nobody really saw a market for it. I'm wondering if, I mean, do you guys see if this was revolutionary or just something that nobody's done before because it didn't seem like there was a market?
Honestly, Jeff, I think you're absolutely right because a lot of those money market investors, they like to see it at the $1 NAV. They don't want to see even those minuscule fluctuations in their
Right.
principal. And this isn't that, right? You're going to see the market price fluctuate just a little bit. And that I don't think a lot of investors will appreciate. And also, functionally, it's going to be pretty much the same as the many ultra short-term bond ETFs that are already out there. The ETFs like SGov, the ETFs like BIL, these already hold treasury bills. Their entire portfolios are made out of treasury bills. And this new fund is going to be pretty much the same thing. The only difference is, the rule that it's following mandates that 99.5% of its portfolio has to be made up of treasuries, while the typical ultra short-term bond ETF, I think it has to hold 85% or something like that in cash-like securities. But in reality, they hold pretty much their whole portfolios in treasury.
Yeah.
So it's going to be the same thing. I think it's kind of a marketing thing. If people want money market funds, they should go out and buy a money market fund, not this kind of quasi money market
Yeah,
fund.
it will be a fun one to watch, but my gut tells me that you're basically creating an ultra short-term bond fund and calling it a money market fund that's unique.
Yep.
But as you just said, Samit, the unique part is what money market investors don't want.
Yeah,
They don't want that dollar to break.
exactly.
I would just make a really short comment on that. And that just shows the flexibility and experimentation and pioneering of exchange traded funds. It's part marketing, sometimes throw things out there to see if they stick, if you will. So interesting story. And I like to see things like that come along because the ETF industry can experiment with things and see what investors are interested in.
Absolutely. You're absolutely right, Ken. And I should add that ultra short-term bond ETFs are great just because their price moves a little bit. I have no problem with that. The price movements are so small, and that's just the nature of having a vehicle that is intraday liquid. You're going to see the price move up and down just a little bit. Yeah, I think that's a great place to wrap it up. We covered a lot of ground. Thanks for tuning into Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or want to share your thoughts, join the conversation with us on Twitter at ETFcom. That's ETFcom. Catch you next week.